The Reserve Bank of India has announced its last monetary policy review of 2024. And as expected, the Monetary Policy Committee or the MPC has kept the repo rate unchanged at 6.5% for the 11th consecutive meeting. But there's lots to unpack from today's announcement, so here's a quick breakdown. Firstly, why no change in the repo rate? Well, with inflation stabilizing but still higher than the RBI's target range of 2% to 6% and economic growth slowing down, the MPC decided to stick to its neutral stance that it adopted in the last meeting held in October. In fact, Governor Shaktikanta Das has called this a prudent move to balance growth and inflation. In simple terms, they're waiting to see how key economic indicators perform before making any big moves. Now, let's talk inflation. October saw inflation spike to 6.2%, mainly due to the persistent rise in food prices. While the RBI expects it to moderate in the second half of FY25, averaging at 4.8%, the risks aren't over yet. Adverse weather or higher global commodity prices could push it back up. And let's not forget, the RBI has raised its inflation forecast for the next 3 quarters, which shows they're keeping a close eye on price pressures. A key takeaway from this meeting has been the cut in the cash reserve ratio or the CRR by 50 basis points to 4%. And what does that mean? Well, banks now have an extra 1.16 lakh crore rupees to lend. This move is likely to ease liquidity pressure in the banking system and stimulate lending, especially when economic growth is slowing. This essentially aims to keep the economy moving while ensuring inflation remains under control. This could also support the rupee, which has been trading at its lowest against the US dollar. The RBI is also setting the stage for 2025 with a new benchmark for overnight rupee rates. Speaking of growth, the RBI has revised its GDP growth projection for FY25 downwards to 6.6% from the earlier 7.2%. This after GDP growth was at its lowest in 2 years at 5.4%. which is a major cause of concern, especially with weaker private consumption and investment. The RBI, however, remains fairly optimistic, expecting growth to pick up in the later quarters, supported by resilient services and better agricultural output. The RBI also announced a boost for farmers by raising the limit for collateral-free agricultural loans to Rs 2 lakh, up from 1.6 lakh per borrower. This move aims to provide financial stability to the agricultural sector and facilitate higher credit availability. RBI has increased the interest rate ceilings on FCNR-B accounts to make India a more attractive destination for foreign investments. And what is the FCNR-B account? It is a specialized banking facility designed to cater to the financial requirements of the NRIs and PIOs. It basically lets them maintain a fixed deposit in India in freely convertible foreign currencies for a tenure ranging from 1 to 5 years. And since the account is maintained in foreign currency, it secures the funds against currency fluctuations during the tenure of the deposit. As we enter the new year, inflation and growth will remain key challenges. But for now, Governor Das and the MPC continue to remain cautious while carefully balancing the need to control inflation and supporting economic growth. And that's a wrap up on RBI's last MPC meeting for 2024.